Let's talk more about today's market action. Joining us now, Dan Suzuki, Deputy Chief Investment Officer at Richard Bernstein Advisors. Dan, always good to see you. We were debating the kind of economy you should position yourself for in the markets. So which economy do you position your portfolio for?
Yeah, it's a really good question. Thanks for having me, Melissa. I think that the conversation that you guys have just been having is a great parallel with the way the market's looking at it. I mean, there's this big debate between the here and now, which is clearly getting worse, and next year, which is clearly that outlook is improving. So which economy do you want to prepare for? I don't think you want to go over your skis and go all in on one or the other, but I do think that the most important question for investors is, are profits going to be higher 6 to 12 months from now, or are they going to be lower? And I think the path of least resistance, kind of what Tim was talking about, is higher, that things are going to be better. Clearly, this near-term outlook, the way I think about it is, the worse the near-term pain gets, the harder it is for the market to look through it. So I think that you do want to have some of those risks balanced in your portfolio. That's what we're still holding. But most importantly, we are trying to position for the companies that are going to benefit and drive that profit growth next year.
Hey, Dan, it's Tim. Thanks for joining us. So you speak of the risks balanced, and you speak of those companies that will drive growth next year. What sectors do you want to be in? We've talked about some of the cyclicality. We've talked about banks being cheap. What do you guys care about?
Yeah, so since April, we've been adding some of those that cyclicality to the portfolio. We've been adding energy, materials, international small caps, most recently, U.S. small cap value. These are the types of things that we're adding to the portfolio along with credit. Those are all the investments that are going to benefit from that improving growth outlook next year. But if you look at some of the other stuff we hold in the portfolio, we do have a little bit of that barbell in that we're overweight healthcare, we're overweight staples. We still have gold in the portfolios. And if you're worried about those risks that Dan was talking about, China actually doesn't have a lot of those risks because they don't have a COVID crisis and they don't have a fiscal cliff. So in a lot of ways, they can be considered defense today as well.
Dan, a weaker dollar has been a tailwind for multinationals. At a certain point, does it become a headwind for the broader market?
No, I don't think so, Guy. I think that clearly a stronger dollar you have to watch out for, but that's clearly not the case today. When it pertains to the weaker dollar, I think what matters is what's driving that weaker dollar. And the fact is, what the big driver of that weaker dollar is the fact that the market is starting to price in that recovery next year. So I don't think that becomes a headwind to anything that we're seeing in the markets today.
Dan, thank you for joining us. Jesse, the dog, liked your appearance as well. Dan Suzuki, Richard Bernstein Advisors. So I'll go to Karen, since Jesse seems to have a lot to say. He walked out of the room, I think. Would you consider China being defensive? I mean, you were looking for some protection in your portfolio, and traditionally for you, that means the options market. But could you see China as playing that role?
I guess, although I think you're taking on other risks as well. So, for example, trade tensions getting worse, something like that, you would be buying that bet as well. But I do think it's instructive to look at China and the bounce back, as Dan was talking about, the bounce back there. And, it's not a giant leap to think we could have a similar type of quick and sharp recovery.
Shepard Smith here. Thanks for watching CNBC on YouTube.